What's going on, guys? Welcome to the Speculators Guild. Once again, I'm Tyler, aka Gilded Golf Trader, and today we're going to break down what is auction market theory. So, today we're diving deep into auction market theory, and it's a framework that fundamentally changed how I approach trading. Before I learned AMT, trading felt like gambling. I was reacting to price movements without understanding the underlying dynamics. After learning auction market theory, trading felt like reading a book. Every candle, every move had meaning and context. This shift is what we're going to explore today. In this presentation, I'm going to give you a complete beginner's guide to the auction market theory. By the end, you'll understand concepts that most traders never learn in their entire careers. These aren't just theoretical concepts, they're practical tools that will change how you read charts and make trading decisions. We're going to transform how you see the markets, moving you from simply reacting to price to understanding the auction process itself. Let's dive in and start building that foundation. What is auction market theory? At its core, auction market theory is a framework of understanding how markets actually work. The fundamental premise is simple but powerful. Markets operate as a continuous two-way auction between buyers and sellers. Think about a traditional auction. The market works the same way, just much faster and more complex. Every tick of price movement represents the market searching for a level where buyers and sellers agree to transact. When price finds a level where lots of trading occurs, that's an area of value. Both sides see it as fair. But when price moves quickly through a level with little trading, that tells us the market rejected that price as unfair. The beauty of auction market theory is that it helps us to understand why behind the price movement. We're not just looking at the lines going up and down. We're reading the ongoing negotiation between marketing participants. This shift in perspective is what transforms trading from feeling like gambling to feeling like reading a structured story. Auction market theory gives us a lens to see the market structure, identify where the market structure has found value, and where it's likely to go next based on the auction process. Now let's look at what this powerful idea came from. Auction market theory has its roots in the work of Peter J. Steinmeier, a trader at the Chicago Board of Trade in 1980s. Steinmeier developed what he called the market profile, a way of organizing price and time data to reveal the market structure. He realized that traditional bar charts and candlestick charts were missing critical information about where the market was spending its time. Market Profile uses time price opportunity or TPO charts to display price distribution over time. This creates a visual representation of value. The areas where the market spends the most time are the areas of the highest acceptance. That's where value is. Steinmeier's work was revolutionary because it shifted focus from just price movement to understanding market behavior and participation psychology. James Dalton later expanded on Steinmeier's work, making it more accessible and practical for traders. Dalton's books, especially Mind Over Markets, became a definitive guide to applying auction market theory in real trading. Today, auction market theory and market profiles are used by institutional traders and sophisticated retail traders around the world. Understanding the history helps you appreciate that auction market theory isn't just a technical indicator. It is a deep framework for reading market behavior. Now, let's dive into this concept starting with value areas. The value area is a price range where 70% of the day's trading volume occurred. This is the heart of the auction. Think of this as a zone where both buyers and sellers agreed that price was fair. The market spent most of its time here because it's where most of the efficient trade took place. The value area is bounded by value area high, also known as VAH, and the value area low, also known as VAL. These boundaries are critical reference points. When price is trading inside the value area, the market is balanced. When price moves outside the value area, the market is testing for new areas of acceptance or rejection. Here's a key insight. The value area is not static. It shifts as the market perspective of fair value changes. In today's value area is higher than yesterday's, then that tells you the market is accepting higher prices. Bullish sentiment. It is a lower, the market is accepting lower prices. Bearish sentiment. For trading, the value area gives you context. Are we in a balanced in or out of balance? Is price at a premium or is a discount relative to value? These questions guide your entire trading strategy. So let's visualize this concept. Now let's see the value area in the action on the volume profile chart. The bell curve you see here represents the distribution of volume at each price level. The fastest part of the curve, the bulge in the middle, is where the most volume is traded. That's the value area. Notice how 70% of the volume is concentrated in that zone. The top of the zone is the value area high, and the bottom is the value area low. Everything outside of the range represents prices the market only briefly explored. These are areas of lower acceptance. When you look at your charts, you should immediately identify where is today's value area. Then you ask yourself, where is price relative to this zone? If price is above the value area high, we're trading at a premium. The market is testing whether buyers will accept these higher prices. If price is below the value area low, we're at a discount, and the market is testing whether sellers will accept these lower prices. If price is inside the value area, we're in balance, and you should expect rotation and chop. The visual representation is your roadmap for understanding market context. Now let's look at the single most important price level within the value area, the point of control. The point of control, or the POC, is a price level where most traders traded during the session. It is a single most accepted price, the fairest price in the market's eyes. Think of the POC as a center of gravity for today's auction. Price is magnetically drawn to this level because it represents maximum agreement between buyers and sellers. The POC is incredibly important for several reasons. First, it acts as strong support or resistance. If the price is above POC, the POC often acts as support or pullbacks. If the price is below POC, it acts as resistance on rallies. Second, the POC is a key reference point for understanding whether the market is balanced or trending. If the POC is migrating higher throughout the day, that is a sign of a bullish trend. If it's migrating lower, that is a bearish trend. Third, the POC from the previous day remains relevant. Yesterday's POC is a critical level to watch today. The market has memory, and it often returns to test these high volume nodes. For your trading, you should always mark the POC on your chart. It's an anchor point. When price moves away from the POC, you're watching to see if it finds acceptance at new levels or if it gets pulled back. Let's see how the POC influences price action. Here's how the point of control behaves in a real market condition. Notice how price repeatedly returns to the POC throughout the session. This is a magnetic effect we talked about. The market keeps coming back to the fairest price. When price moves away from the POC, you should be asking, is this a genuine breakout or a temporary excursion that will snap back? The answer depends on whether the market finds acceptance at the new price level. If volume starts building at the new level and a new POC forms there, that's acceptance. The market is migrating to a new fair value. But if the volume is thin and the price quickly returns to the original POC, that was a failed auction, a rejection. For trading, the POC gives you high probability zones to enter trades. Buying near the POC is an uptrend, or selling near a downtrend often provides excellent risk reward because you're entering the market at the center of gravity. Also, watch for POC migration. If the POC is steadily moving higher, then that's your signal to stay long and add to positions on pullbacks. Now let's move into another critical concept, the initial balance. The initial balance, or IB, is the price range established during the first hour of trading. This is the market's opening auction, where early participants set the boundaries. The IB is critical because it defines the day's structure. Think of this as a foundation. Everything that happens later in the session is measured relative to this range. The width of the initial balance tells you a lot about the market's energy. A narrow IB suggests the market is coiled and ready to break out. There's low conviction early, but that often precedes a strong directional move. A wider IB suggests the market has already done its work. The range is established and you should expect rotation within the range rather than a breakout. The IB high and the IB low become key reference points. When the price breaks above the IB high, that's a bullish signal. The market is extending higher, searching for new value. When price breaks below the IB low, that's bearish. For trading, your strategy depends entirely on whether price stays inside the IB or breaks out. If it stays inside, you trade the range. If it breaks out, you trade the trend. Let's look how to use this IB strategically. Here's how to trade around the initial balance. First, measure the width of the initial balance. Is it narrow or is it wide relative to recent days? A narrow IB often leads to a breakout later in the session. The market is compressed and the energy is building. In this case, you want to prepare for a range expansion trade. Wait for a decisive break above the IB high or above the IB low, and then enter in the direction of the break. A wide IB, on the other hand, suggests the market has already established its range. In this case, you should fade the extremes. Look to sell near the IB high and to buy near the IB low, targeting the middle of the range. Second, use the IB extremes to your stop levels. If you're long and the price breaks back inside the IB, that's a sign of a breakout failed. Exit. If you're short and price breaks back inside, cover your short. The IB is your structural anchor. Finally, watch for acceptance outside of the IB. If price breaks out, then spends time building volume at the new level, that is a sign of a genuine move or acceptance. But if price immediately snaps back inside the IB, that was a false breakout. Now, let's talk about two more advanced concepts, single prints and excess. Single prints and excess are two of the most powerful concepts in auction market theory because they reveal areas of rejection. Let's start with single prints. A single print occurs when price moves through a level so quickly that it only prints one TPO profile. This means the market visited that price level and immediately decided it was unfair, either too expensive or too cheap. As a result, price moved away rapidly. Here's the key insight. Single prints often act as support or resistance when price returns to them later. The market remembers these levels were previously rejected. Think of single prints as footprints, showing where the market ran quickly through territory it found unacceptable. Now, let's talk about excess. Excess is a special type of single print that occurs at extreme highs or lows of a move. It represents where the point of the market was pushed to an extreme and it found absolutely no acceptance and reversed sharply. Excess is significant because it often marks the end of a directional move. When you see excess at a high, it suggests that buyers pushed the price as far as they could, found no willing to buy at that level, and sellers took control. This often marks a swing high. For trading, single prints give you an area to watch for support and resistance on retests. Excess gives you potential reversal points. Both concepts are the market's way of saying we went too far. And that message remains relevant for futures trading. Let's look at how these appear on the chart. We just talked about single, print, and excess areas of rejection. Now let's see it to spot them on the chart, and more importantly, how to use them. Single prints are also thin areas of volume profile where price moved through quickly. The market essentially said, this price is unfair, and ran away. These areas are crucial because they act as market memory. When price returns to a single print zone, it often acts as strong support or resistance. The market remembers the rejection. Mark these zones and watch for a reaction when price retests them. Excess, on the other hand, is the sharp rejection of extreme high or low of a move, often visible as a long wick on a candlestick. This is the market pushing to an extreme and immediately reversing. Excess signals that the move is likely exhausted. The tip of that wick becomes a high probability reference point for a potential reversal. If you see excess at a high, that level is now key resistance zone. If you see it at a low, that is a key support zone. These rejection zones are just historical data. They are actionable levels for future use. Now that we understand rejection, let's look at how these rejections and acceptance from the overall structure of the trading day. Dalton's day types. Now we're moving into a powerful framework for anticipating daily market behavior. The Dalton day types. James Dalton, who worked with Steinmeier, realized that the market days fell into four distinct patterns. Recognizing which pattern is developing early in a session is key to choosing the right trading strategy. The four types are normal day, normal variation, trend day, neutral day. A normal day is balanced auction, where the market explores both higher and lower prices but returns to the middle. It is a two-sided balance. A normal variation day is a failed directional move. Price extends strongly in one direction but then fails to return to balance. This is a classic failed breakout. A trend day is a continuous directional movement with minimal retracement. This is a high conviction from one side of the market. And finally, a neutral day is a complete balance with price chopping within a tight range all day. Each of these day types requires a completely different trading approach. You can't trade a trend day the same you would trade a neutral day. By recognizing the day type, you align your strategy with the market's behavior rather than fighting it. We'll start breaking it down with the most common type, the normal day. The normal day is the most common pattern you'll see, and it represents balanced, efficient auction. The key characteristic is the market explores both sides. It establishes an initial balance that extends slightly above the IB high and slightly below the IB low. This is a two-sided range extension. The market is testing the boundaries but finds no strong conviction to trend in either direction. As a result, the value area forms right in the middle of the day's range, often creating a classic bell curve volume profile. For trading, this means you should adopt a mean reversion playbook. Don't chase breakouts on a normal day. They almost always fail. Instead, you want to fade the range extensions. Look to short near the highs and buy near the lows. Your target is always in the middle. That's the point of control. Expect rotation and expect chop. The market is efficiently facilitating trade, so price will oscillate back and forth. If you identify a normal day developing, your goal is to trade the edges and target the center. Now, let's look at a day type that often tricks traders into thinking it's a normal day is developing, only to reverse sharply. The normal variation day is a critical pattern to recognize because it represents a failed directional move. This day starts with the market establishing initial balance, just like a normal day, but then price extends strongly in one direction, looking exactly like a breakout. This is the market testing a new price level. The key is the market finds no acceptance at that extreme. The extension stalls, often with low volume or the formulation of excess, signaling the rejection. Price then fails to hold the extension and rotates back into initial balance range. This pattern is a gold mine for counter trend traders because it traps breakout traders. When you see the extension stall, you can fade the move and trade the return to balance. Your target is the initial balance, high or low, even the point of control. This is the market's way of saying we went too far and we're coming back to where we agreed upon value last. If you see one side extension early in the day but notice signs of exhaustion, prepare for this pattern. Now, let's look at the opposite extreme, a day with overwhelming directional conviction. Trend days are the most profitable day types if you're positioned correctly, but they're also the most rare. This day is characterized by continuous directional movement with minimal retracement. The market has made up its mind it's moving with overwhelming conviction. The key identifying feature is that initial balances form at one extreme of the day range. Price breaks out of the initial balance and continues to extend in one direction all day, never looking back. The volume profile is thin and elongated and shows continuous value migration. The market is finding acceptance at progressively higher or lower prices throughout the session. The trading strategy here is simple but difficult to execute. Enter early and hold. Do not take quick profits. You must let the winner run. Any shallow pullback is a buying opportunity, and you should use the IB extremes as your stop. The critical rule for a trend day is to never fade them. Trying to pick a top or bottom is the fastest way to blow up an account. If you recognize that this pattern developing, align with it and let it run. Now let's look at the opposite of a trend day, a day with no conviction at all. The neutral day represents a market complete balance where neither buyers nor sellers have any directional conviction. This day is characterized by a tight initial balance with little to no range extension for the rest of the session. The entire day's trading range often stays within the first hour's range. The volume profile looks short and fat, showing price rotating back and forth through the same levels repeatedly. This is pure chop. Neutral days typically occur when the market is waiting for new information or consolidating after a big move. For traders, the best strategy is often patience and preservation. The risk of getting chopped up by false signals is very high. You must trade, you should scalp the edges. Fade the extremes of the initial balance for small, quick profits, but do not hold for directional moves. Your trend following systems will generate false signals all day long. This pattern is the market building energy for a future move, but not today. Now that we've covered the 4 day types, let's look at how to integrate these concepts into a systematic analysis. It's time to put it all together. All these core concepts and this systematic process for reading the auction in real time. We can break the analysis down into 4 phases. First, in the pre-market phase, you establish context. Identify yesterday's value area and POC. The key question is, are we opening in balance or out of balance relative to yesterday's value? Second, during the opening, you define the initial balance. Is the IB narrow, suggesting a breakout potential, or is it wide, suggesting that the range is already established? Third, as the day develops, you watch the range for extension. Is the breakout accepted, which you'll see with single prints, or is it rejected, which you will see with the excess? The key question here is whether value is migrating with price, or if price is simply just overextending. Finally, at the close, you compare the closing price day at the value area. This sets the sentiment for the next session. Did the buyers or the sellers win the day at the auction? Following these 4 phases, process ensures you systematically integrate value area, POC, initial balance, single prints, and day types into a coherent market narrative. Now, let's walk through a real world example and see this in action. Let's apply our 4 phase framework to the real world example and build a complete market narrative. First, context. The market opened inside yesterday's value area, suggesting an initial expectation of a balanced or normal day. Second, the structure. The initial balance was narrow, but price broke above the IB high with a strong volume. This created a P-shaped profile, which often signals short covering and a bullish bias. Third, key levels. Notice the point of control migrated higher throughout the day, confirming that the value was successfully being accepted at higher prices. The lower tail shows clear excess, which is a strong rejection of the lows, confirming buyers are in control. The trade execution is biased and clearly bullish. We look to buy pullbacks in value area high because the auction is successful finding acceptance at higher prices. This complete analysis gives you a clear understanding of market structure, context, and the likely direction of the move. This is the power of auction market theory. Now, let's discuss some of the common mistakes traders make when applying these concepts. We've covered the core concepts, but as you start applying them, you need to avoid these common pitfalls. The biggest mistake is treating AMT levels as concrete walls. Remember, value area high, value area low, and POC are not exact, impenetrable barriers. They are zones of previous acceptance or rejections. The fix is to treat them as zones and watch for the market's reaction before entering a trade. Another costly mistake is fading a trend day. When value is clearly migrating and the market is trending, do not try to pick a top or the bottom because the price looks high. Go with the flow. The market is telling you it has found acceptance at higher prices. Also, always check context. Don't trade blindly at the open. Ask yourself, are we opening inside yesterday's value or are we opening outside at a premium or a discount? The simple question dictates your entire strategy on the day. Finally, avoid overtrading, the chop. On neutral days or inside narrow initial balances, there is no edge. Preserve your capital and wait for the market to break out and test the extremes. Auction market theory is a framework for understanding the market behavior, not a mechanical system. Avoid these traps and you'll be on the right track. If you want to learn more, please join us in the Speculator Guild Discord or join our 4-week mentorship program where we do a deep dive on all parts of auction market theory and you get to work one on one with me